Before we get started with today's show, I just want to take a couple minutes to talk about permissionless for the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. It's only a couple months away. So be sure to act real quick there to get the best deal. All right, back to the show. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. What's going on, everybody? Welcome back to another episode of Forward Guidance. And joining me today is Neil Dutta of Renaissance Macro, repeat guest on the show. Neil, it's great to have you on the show. How's things?
Good. Thanks for having me, Felix. Good to see you.
Yeah, likewise. This has been an overdue appearance, so I'm super excited to get you on the show. You are one of my favorite economists, and I think one of the big reasons why, as I've been reflecting on it, is you yourself call yourself a business economist, which I think is an important nuance in that you bring the complexities of the economics world, but you always make sure to ground it in markets, and I think that's a super important way to look at things. So yeah, props for that. I'm sure we'll get into a lot of different things here on the show.
Looking forward to it.
I wanted to start the conversation off by looking at how you were looking at the economy over the last couple of years. Because if we rewind back to 2022, we're sort of in what feels like a similar situation where back then we had 2 quarters of negative GDP prints. One of them got revised higher later on. But overall, a lot of that was actually just due to huge whipsaws in net exports and specifically huge imports, which dragged down GDP. And during that time, felt like almost every economist was all in on recession is imminent, except for yourself. You faded that. And now here we are today. We got the first quarter GDP print last week, and it was negative, and a lot of that was due to significant imports as well, which brought it down. But what's different this time is you are more in the camp, as I understand it, of either recession being imminent or in the early innings of one. So I would love to just unpack on what has changed, right now versus that 2022 framework that you are more concerned about recession.
Well, sure. The framework hasn't really changed. If you go back to that period, right, we had essentially a big shock to disposable income, right, because of the Russian-Ukraine situation. So that kind of sent food and energy prices through the roof. But because labor markets were still okay and people were sitting on a large pool of excess savings, they were still able to go out and spend. By the end of the year, you had seen things like, okay, so by the end of the year, real incomes were starting to turn around. That was really the main focal point of that call about no recession is that, look, by the end of the year, gasoline prices basically round tripped. And because labor markets were fine, inflation was cooling off a lot more rapidly than the job market was. And so as a result, you basically see a boost to disposable incomes going into 2023. So that was the main thing. The second thing is I noticed that even though the Fed had been hiking aggressively, housing was kind of hanging in there. If you look at the performance of home building stocks, they were actually outperforming. And that's a very unusual recession. You typically don't see housing stocks outperforming in recession periods. And I would also say the government was going out and spending lots of money. That was another thing, right? So state and local governments were spending money. The federal government was spending money. And then finally, I think there's a surprise. I think one of the ways recession works is through an element of surprise. And as you mentioned, everyone was anticipating a recession. So if people were preparing for a recession and it didn't arrive, that means that you need to actually catch up to where growth is, right? So there's a period of, you have to restock your inventories and spend more on investment and hiring and so forth. And that, so the expectation of a recession not happening, makes one ultimately less likely to happen in the first place, right? So if you just apply that framework to the present, what do we know? We know that there's actually no excess savings anymore, and the labor markets are slowing down. This was true before tariffs. This is going to be true after tariffs, but real income growth has been quite sluggish, which isn't surprising because there's more slack building in the labor markets. So that's point number one. You look at the housing market. I mean, just pull up a chart of home building stocks. They've been underperforming the market. Home building sentiment is weak. And interestingly, despite the Fed having cut last year, housing stocks were still underperforming. So that to me is a problem. And what you're seeing now is in the meat of the market, home inventories are rising, right? And that's weighing on prices. But, builders, they're sitting on the most completed unsold inventory that they've been seeing, I mean, really since the financial crisis. So that to me means that there's going to be less residential construction activity. The government isn't a tailwind to growth. That's number three, right? I mean, that's not just true of the federal government. I mean, Doge, not so much in the last couple of weeks, but certainly that gets most, that's kind of sucked a lot of the oxygen out of the room. But the truth is that state and local governments are in a much trickier spot now. I mean, they basically have exhausted their pandemic relief money, but more importantly, they treated their pandemic relief money as if it was permanent, and that's kind of putting them in a situation that's not necessarily the best right now. And then it's that surprise factor, right? Going into the year, who was talking about recession? No one. Nobody was talking about recession. And if you look at what the consensus saw for GDP growth in 2025, it was about 2%. That's year over year at the end of 2025. And then if you look at where the blue chip consensus is right now, it's basically 0.5%. So you saw like a 1.5 percentage point downward revision to growth expectations this year. So that to me constitutes an element of surprise. You typically don't see that outside of recession, meaning that magnitude of revision for the current year. So in such a short span of time, you really have to, outside of COVID, you have to go back to like 09, 08, 01 to see something like that. So to me, there's an element of surprise here. So I would just say that for those reasons, I was already cautious. I've been kind of very concerned about the outlook to begin with. I think what's happened since then, with the obliteration day, that's what I call it. You can't spell liberation without obliteration. So at any rate, that just makes a bad situation worse, right? And the most obvious kind of effect that we've seen from the announcement around tariffs isn't really, it's not around inflation, it's not around employment. What's happened primarily is the rapid adjustment in capital spending intentions across the business community, right? They basically thought that they were going to be gearing up after Trump won, and now they are shelving their plans to spend. So we'll see whether that bleeds into the actual data. But that to me has been the most obvious consequence of what's happened. So it's sort of a bad situation has been made worse.
Something I've been trying to figure out is specifically looking at the government expenditure side of things. Is on one side you have what is correct, which is that state and local municipal level spending has dried up from the COVID era of stimulus. But on the same vein, the one thing that has remained constant is that we're still at a 7% of GDP fiscal deficit. And the detractors of the idea of going into recession would say, how do we go into a recession when we're still running basically like a recessionary fiscal deficit during what is maybe still an expansion? So my question to you is, can we see a durable, sizable recession with a 7% of GDP fiscal deficit?
Well, I think you can, because that's not necessarily how GDP accounting works. Remember, it's the change in the deficit that drives contributions to GDP growth. So if the deficit is the same one year to the next, that means that the cyclical impulse from government to GDP is basically zero. So it's just that to me is a misunderstanding of how the accounting behind GDP works. Now, that being said, I would tend to agree with the idea that that it shouldn't be particularly deep. There aren't many imbalances in place. So I think that's important. And that limits how much downside there's going to be. So that's good as well. But that doesn't, I mean, to me, the recession in my mind is probably shallow but prolonged. And I say that because it's really a significant confidence shock, and it's hard to put that confidence genie back in the bottle once it's out. You look at, I don't know, I kind of liken it to the 2001 to 2003 period, where we basically had like 9/11, corporate accounting scandals. We had like accounting reform. We had the run up to the Iraq War. It was just shock after shock after shock, just kind of hitting the corporate sector. And to me, it feels a little bit like that, because it's never over with Trump. So it was confidence shock after confidence shock. And now, and it kind of feels like that. I mean, we're talking about a fairly meaningful hit to corporate confidence. I mean, when people bet on Trump, they were betting on what? Tax cuts, deregulation, and tariffs. But they were betting on it in that order. And we obviously didn't get that, right? So, and the administration is talking about strategic uncertainty. The corporate sector is looking for what? Certainty. So from the administration's perspective, uncertainty is a feature of the approach they're taking with trade. And the business community, Wall Street, financial markets, they like to know about things. So, that makes it quite challenging on top of all the other issues that we just opened with. So, I mean, it's a pretty tricky kind of situation. I mean, I will say, like, this is why I don't expect the recession to be particularly deep. I mean, you've never had like a big calamity because of uncertainty in and of itself. Now, that doesn't mean what they're doing is actually, I mean, it's not just about the uncertainty per se. It's about what's actually happening. And what's actually happening is a fairly meaningful shock in terms of, the effective tariff rate going up, for example. But as I say, I mean, what sector of the economy is particularly bloated in the private sector right now? I mean, household balance sheets are fine. Residential investment is not stretched. Even CapEx. I mean, maybe AI is stretched, but that seems to be somewhat insulated from the business cycle as it is. I'll just say that we have an economy that's kind of not really firing on all cylinders, and we have negative fallout from trade. To me, that kind of the die is cast for a recession.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. Something I've been trying to figure out, I'm curious if you could help us understand, is just how do you navigate the one thing that we do know that corporations are doing right now is front-running tariffs by trying to bring forth a lot of goods forward. So we've seen huge amounts of imports. We've seen the trade deficit. We just got the release today, and it's basically doubled since November. And I'm trying to figure out now, okay, what does it mean? How does that cascade through? Does that lead to increased inventory levels in corporations? And then if you see a cut to consumption, like we're starting to see already, if you have bloated inventory levels and then a decreased consumption, does that start to create like a supply gut? So I'm just curious, like, how do you think about the cascade of a huge amount of imports hitting an economy? How does that play out?
Well, I mean, the imports ultimately have to go somewhere, and I don't know that there's a huge buffer of goods. I mean, if you look at the details within the trade data, um, a lot of the increase in consumer goods appears to be related to pharma. I mean, I think it's an open question, like exactly how much inventory is sitting on the shelves of the retailers that people typically go to. Um, so I think that's something to keep in mind. I mean, I have to go through the data more, but I wouldn't say that, when you say like inventories, people assume, okay, like Walmart's going to be stocked and like, the data don't necessarily demonstrate that. What it shows is that a lot of the increase in consumer goods inventories was a function of like pharmaceutical stuff. And, that to me is maybe suggests that there may not be as much of a cushion on store shelves than people had thought. Now, that being said, the way this should work is basically the inventories are ultimately drawn down and you start to see more kind of shortages, at which point prices will begin to perk up. And there's going to be substitution, right? I mean, if something's not there, I mean, people just won't go out and spend. And that means they may have to spend elsewhere, which could mean that, retail employment comes under pressure because there's really not much reason to go to the store if you can't find things. Same for motor vehicle dealerships, right? I mean, if there aren't as many cars out there to sell because of tariffs, then there's going to be fewer people selling cars. So I think the hit to employment from this should probably be sometime towards the end of this month. I mean, absent some kind of change. But even then, like as I said, the die is cast. I mean, there are ships that have to go from the east coast of China to the west coast of America, and then they are loaded onto trucks or rail, and they move throughout the country, right? So as I say, I mean, like I say, the die is cast. Like it's like COVID in a way, right? I mean, once the supply chain is shocked, you can't just turn the switch back on and just assume everything is like hunky dory again. Like you break things, it takes time to put Humpty Dumpty back together, and that's kind of what's happened right now. So if you let's say under some kind of miracle scenario, there's like a capitulation on the China trade story, it would probably be sometime in the middle of the summer before like things start to feel normal again. For the real economy. Markets would obviously front run all of that.
I'm curious, how do you square that with this bifurcation that we've seen between the soft data and the hard data? And, if we see this continued, like if we're talking about potential shortages, does that create just this small blip, this mirage of sorts in terms of the hard data where you get this blip and it actually takes longer for the actual recession to start to show up into the hard data? How do you discount the dynamic? And how do you think about this bifurcation between the soft data and the survey data, which was just, spell and doom, and the hard data, which is still somewhat okay? Or is it just like a lead lag thing?
Well, I think that's certainly part of it. So I'm a big believer in the idea that, sort of survey-based measures of economic activity are useful in helping you refine your forecasts. There's a lot of talk about, a couple of years ago, like the vibe session, right? I mean, so this idea that, consumers tell you they feel like really crummy about things, but in reality, they're still going out and spending, and they're still going out and, I mean, they're still going out and finding jobs and so forth. See, I don't believe that there's really that much of a disconnect between what's going on with the surveys and it's just about what surveys you're looking at, right? So for example, one thing I like to look at is the conference board labor differential, right? This is the measure of consumers telling you, are jobs plentiful or are they hard to get? And the difference between the two is basically considered like a rough proxy for the unemployment rate. Guess what? It's more or less been following the unemployment rate as it's been deteriorating, right? I mean, it's been following labor demand as it's been deteriorating. So it does work. How about capital spending intentions across the regional manufacturing surveys, right? I mean, so every month the Fed, through its regional banks, surveys district contacts. They ask them sort of up, down, sideways, your 6-month business investment outlook. Guess what? That more or less has been tracking with core durable goods shipments. So it's not so. So all these surveys basically show a sudden stop type of dynamic. Okay, I mean that is true. And one of the things, I mean, this is something that Secretary Bessent has made a point of, is that, I mean, not necessarily in this way, but he's talked about how Wall Street like loves instant gratification. And that's kind of true with this too, right? I mean, people see a sudden stop in the survey data, so they assume like, okay, that means that everything's going to hell right now.
Right now.
But that's not necessarily always the. I mean, first of all, tariffs are not sudden stop like events, right? I mean, so that's the first point. This isn't like COVID where the government is basically telling you to stay inside, and I mean, in a weird way, like shutting the economy down was the way you dealt with the virus, right? So it's a different kind of dynamic. So there's no sudden stop. It's not even sudden stop like the way the financial crisis is sudden stop, right? Like it's not like credit is freezing up. I mean, if anything, corporate credit conditions have been okay. I mean, just look at a chart of like high yield spreads, right? So, but this is more of a, to me, what it basically represents is we had a linear slowdown. We've kind of walked some of it back with this 90-day tariff pause. That, I mean, so the Liberation Day made a linear slowdown somewhat nonlinear in nature, and now because of Trump kind of caving a little bit on the reciprocal tariffs, we've gone back to that linear slowdown story. So that's kind of how I see it. So as I say, like people are looking for instant gratification. It's not like expect a cathartic drop in consumption because consumer confidence has dropped. I mean, you have to understand why consumer confidence has dropped. It's dropping because of tariffs. And just the overall linear slowdown that we already had in the economy. That's why confidence is weaker. But because of tariffs, people are going to be spending more money today to beat those tariffs, right? So you're not going to get. So I do think that there is some element of the hard data is kind of a mirage because it's very much affected by what happens in how companies and consumers behave to tariffs, which is why I think it makes a lot of sense just to focus on things that are difficult to kind of shift around, like people, hiring, employment. And to me, the signal in the employment data remains fairly consistent, which is it's getting worse.
Yeah, that's a good segue into, obviously we have the FOMC meeting tomorrow, which will be the same day that this interview goes live. And I want to dig in deep on both sides of the dual mandate because it feels like this framework that we just outlined in terms of the growth outlook, et cetera, is making, and Powell has said it himself, is that there's going to be a difficult decision that needs to be made about which side of the dual mandate they need to focus on and prioritize. So let's dig on the labor side of things first here. So obviously we had the NFP last week, and I'm curious about, was there any meaningful signal that you had there in terms of that jobs report? Because this was obviously somewhat stale data before the big shift started to occur in terms of Liberation Day. But what were your main takeaways there, and how does that apply to your general framework of the labor market? And Nor, you already mentioned the differential data that you find is high signal, but yeah, what's the state of play there?
The light on the job market is definitely dimming. I don't think that's a particularly controversial thing to say. It started actually even before the NFP with the ongoing decline in job openings. That's important because I think the relationship between job vacancies and unemployment is one that's important to keep an eye on. This the so-called Beveridge curve relationship, right? And so, basically, shifts along the curve are considered like cyclical changes, and shifts out in the curve are more structural, right? And that's kind of a simplistic way of thinking about it. But and remember, very early on in the recovery, Governor Waller famously said, well, because job openings were so elevated, we could probably cut a lot of those openings without having much effect on unemployment. And he was right about that. That is 100%.
Yeah, I think he said until like 4.75% or something.
Yeah,
we wouldn't see an uptick in the unemployment rate, and obviously we hit that point.
And unemployment's now been going up. And the thing is that you're now operating on a point along the Beveridge curve where any further erosion in excess labor demand, as proxied by job vacancies, will probably mean higher rates of unemployment. So you think about, job openings were declining in March. What do we think happened in April? Probably, we know from data from Indeed, which is weekly, that job openings continue to come down. So I think there is a risk that unemployment keeps going up. So that's the first thing. Before the NFP, that's kind of first principles. Now, looking at the payroll day itself, like both household and establishment, yeah, there are concerns. I mean, I get people are kind of fixated on like, okay, it came in at 177, that's great, but let's be real here. I mean, the numbers were revised down. I mean, those tend to be sort of auto-correlated. So if you have negative revisions one month, they'll probably bleed into negative revisions the month after. So even though we got 177 on April, I will bet, a fairly significant sum of money to anyone willing to take you the bet that April probably gets revised down. Okay, when that number comes out, it's been revised down 8 of the last 10 years, and if you look at the initial survey, how many were collected? It was about half. So that just tells you that there are going to be revisions. It doesn't tell you the direction, but it tells you that there will be revisions. And then looking at the household survey, Slack keeps growing. I mean, if you look at the number of permanent job losers as a share of the labor force, that's going up. If you look at sort of medium-term unemployment, that keeps going up. So that's going to bleed into the duration of joblessness, which I think is a problem because those people are harder to reemploy the longer you're out of work. And then the last thing I'd say, just to put a pin on it, is the cyclical areas of the labor market don't look great. I mean, you look at construction employment, residential construction employment, that's coming down. The fact that energy prices have come down quite substantially. What do you think that means for oil and gas extraction jobs? I mean, it's probably not good. I mean, just a reminder that the president doesn't really care why oil's going down. He just cares that it's going down. So if it's like OPEC plus coming to some kind of supply situation to bring oil down, he's totally content with it, even if it means kind of sacrificing your oil workers on the vine here. And then the manufacturing sector, you look at what's going on in ISM employment, a lot of these sort of indicators looking at factory jobs doesn't look very promising. So, goods producing employment is likely to keep slowing. And that to me is important because that's sort of a cyclical proxy. I think if you're just focusing on the headline establishment number, you might think things are okay, but that's, I think, giving you sort of a false sense of security around the job market. And of course, keep in mind that the presence of like solid jobs data, payroll jobs data, that hasn't stopped the unemployment rate from kind of moving up. I would suspect that continues.
I find it especially interesting too that within that unemployment rate data, the biggest increase it looked like was for job losers, not on temporary layoffs. So that's a bit of a red flag if that's the one that's starting to increase in velocity higher.
Well, you'd also assume that the tariffs probably will increase the number of people on temporary layoff when the data comes out next month. And the risk, of course, is, this is the biggest debate right now, I think, is whether you think tariffs are kind of like a means to an end or the end in and of themselves. And to the extent that you think, as I do, that tariffs are in fact the point, then a lot of those temporary job losers from tariffs might ultimately become permanent.
How do you think about the claims data within this framework? Because we haven't even talked about that yet, but often, is the case is that you will see it show up in at least initial claims will spike higher before we start to see it in the unemployment rate down the road. And it feels like that is, everybody keeps waiting for that 1 week where we get the release and it just surges higher. We actually got that in the continuing claims last week, which is really interesting. I'm quite interested to see if that durably continues to tick higher. But have the claims data been reacting how you would expect within this dynamic, or is there something else going on there?
Well, so the claims data to me look like a very kind of linear slowdown in the job market, right? And so when people think about jobless claims, they almost think of it like credit spreads, right? It's very episodic. So, when it goes up, it tends to go up a lot. But if you're waiting for layoffs to spike, you waited too long, if you're a policymaker, in my opinion. So I think you can kind of, to me, it's sort of the reason it's slowing in the way it's slowing is because of the nature of how the job market's come cooling off. It's basically rates of job finding have collapsed. So I think one way of, and I've mentioned this a lot is just the sort of the bathtub model of unemployment. But basically, you can liken unemployment to water flowing into and out of a bathtub. And if you know how much water is going in and how much water is being drained out, you can forecast how much water is going to be in the tub, right? So it's the same with unemployment. What the layoff rate being where it is tells you is that the flow rate, how much water is going into the tub, is not changing at all, really. I mean, it's just a steady, drip. But what we do know is that because the job finding rate has been coming down, the water is not draining as rapidly out of the tub because people can't find work. And so what does that mean? The overall level of water, in this case, unemployment, will keep rising. And I think that that's still with us. I mean, job finding rates are still very, very low. Job openings keep coming down. So first principles dictates that you should expect the unemployment rate to keep going up, at least over the next couple of quarters. There's nothing to suggest that that wouldn't be the case. So the Fed has on board, I think, 4.4% on the unemployment rate for year end. I mean, we may well be there by the middle of the year, a couple of quarters ahead of schedule.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the number one institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure notes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ONDO.finance, and see how they're bringing capital markets on-chain. Restrictions apply. 4.4%, it isn't necessarily something that's going to get the Fed to start to act with a huge impulse here in terms of cutting, which I think sets up the next side of the discussion, which is the inflation side of the mandate, which feels like is really hampering them from making a move here. So if we just look at inflation expectations right now, it feels like there's huge amount of uncertainty around like the 1-year inflation expectations. They look like they're going to surge meaningfully. But then the medium-term inflation expectations are starting to look like they're going to downtick lower, which does feel roughly right with how you might expect a huge tariff impulse to trickle down into inflation expectations. So I'm curious about how are you thinking about inflation right now? Because obviously we just had like our first, month-over-month deflationary print, negative print just last month. And, the market basically completely looked past that. Bond yields have been surging. So yeah, like how are you thinking about inflation right now?
So to me, inflation ultimately comes down to a household's budget constraints. So, I mean, there's an interesting debate right now on the Fed between, sort of the effect of tariffs on the inflation process and, how important it is to kind of, lean against it or not. And I tend to sympathize more with Governor Waller, like how he's sort of looking at this, which is, basically you could say from more of a dovish angle. I mean, he's not ready to cut in May or anything like that, but I mean, I think he's more willing to say that this is a temporary thing that we probably don't need to lean against because the labor markets are slowing, right? I mean, so with tariffs, right? I mean, if you think about it in terms of like price times quantity, right? Whatever goes into P because of tariffs is going to be coming out of Q. In other words, prices will go up, but you'll be spending less in volume terms. Okay. Now, tell me, how much inflation can you really get if nominal GDP is running below 4%? Like, I mean, that's sort of, to me, it's really that simple, right? It's just look at wage growth. Wage growth in that, we talked about the last month's jobs number. Average hourly earnings are barely running 3% at an annual rate over the last 3 months. So that tells me that the labor markets are cooling off. And if, in other words, the household's budget constraint is not actually able to accommodate the rise in inflation that may come from tariffs. I also wonder a little bit about whether there might be a little bit of a overestimation in terms of how inflationary the tariffs are, at least in the short run. I mean, people are just like people are primed for kind of like a sudden stop in the activity data. They're primed for this massive pickup in core inflation. And I don't know. I mean, I think companies, first of all, their margins are quite elevated, right? So they're the ones that have the ability to absorb the price shock. And I think they're willing to do so because they're not yet sure about how long these tariffs are going to stick. And so if that's the case, they may be willing to temporarily absorb the tariff, eat the cost, in which case consumers haven't really felt it yet. So tariffs increase costs. How much they raise consumer prices remains to be seen. And the last thing I would say, which is something I've been thinking a little bit more about, because to me, one of the most interesting things that we've seen in the markets lately is just sort of, I guess you could say, like this disconnect between like the rates pricing and stocks, right? Like, how could stocks be going up so much, but the markets still think they're going to be cutting 3 times? Like, how do you explain that away? And I sort of offered up a few theories. Like, I mean, for example, like one could be maybe that's the bond market telling you that AI is not the economy. I don't know, right? I mean, like, so that's why stocks are doing so well, is because of AI, tech capex, and so forth. But you can't run a whole economy just on AI and tech capex. Yeah. The other thing I was thinking about is oil.
Yes, I was going to bring that up.
Right?
It broke down.
Yeah, oil has cratered. Now you have this sort of seasonal widening in crack spreads, right? So yeah, I mean, consumers have yet to feel it, but I think they will eventually. I mean, it's just, it's not unusual when oil drops this far, this fast. You see some, kind of, it takes a little bit of time, but at any rate, oil is not the predominant driver of inflation, but it does matter a lot for the sort of month over month changes. And I just wonder a little bit about how's that going to look for the Fed? Right. I mean, you're going to have donuts on core inflation potentially over this late in the spring. And you're going to be like, well, we're worried about tariffs and inflation expectations, so we're not going to do anything. Obviously, consumer inflation expectations are dependent very much on what they buy frequently. Right. Which is gas. And so if that starts to come down, it really undercuts a lot of the rationale for why they're holding off in the first place, I think. So I think it's going to be an interesting kind of, I mean, don't be surprised if Trump and, maybe even Bessent also kind of just start hammering them over the head with this. I mean, it's, look, we just had a donut in March. If, I mean, it doesn't look like inflation's really taking off in April just yet. And then you maybe start bumping up against like lower gasoline prices in May as we go into the summer driving season. I mean, what's that going to do for the inflation statistics? So you can be talking potentially about maybe 3 pretty soft inflation numbers.
Yeah.
And you're talking about the Fed worried about inflation expectation. I'll tell you another thing. I mean, I was thinking about with respect to the Fed is that tariffs will increase the prices for goods, but given the fact that the household budget constraints getting worse, that means that people are going to have to cut back somewhere, right? And they're going to probably cut back on services if they have to allocate more of their budgets to goods. And if they're cutting back on services, right, that'll ultimately push down the prices for services, right? Like your barber is not going to care about tariffs. I mean, they're not changing their price because of tariffs. That's true of your dry cleaner, your personal care stuff, And at least I don't think that's happening. And I do wonder a little bit about that because service sector inflation tends to be sticky. Why? Because it's set with inflation expectations in mind, which again is the primary rationale for why the Fed is not, doing anything right now. And so I just feel like it's, they're they're tempting fate a little bit here, and they might be reading this wrong. I don't know. I mean, I kind of sympathize with some of the stuff that Waller's been saying. Um, Powell, for his part, has been making this sort of balanced argument, right? Like, so the fact that their longer run unemployment estimate is 4.2% and the unemployment rate's at 4.2%, they need to worry more about inflation. But, look, at the end of the day, the Fed is telling you they are willing to be behind the curve. That's their policy right now. They're conditioning themselves to be behind. And that's not a good place to be if you're an equity market investor.
Yeah, 100%. Neil, you took a few of my questions right out of there and just ran with them, which is perfect. I love it, because I was exactly thinking about that, which is that, like, yeah, if oil's coming down, what's going to happen? Fast forward a few months and you have 3 months in a row of a negative headline print. Like, how do you make the case for sitting and pausing, especially if we do get an unemployment rate to 4.4%? So yeah, you put that all together, and then you compare it to the dynamic that was occurring back in September, where they were being proactive for once in a way. And obviously there was still some pretty negative labor market prints at that time. But regardless, going 50, I think you can characterize as being highly proactive, especially compared to right now, where they're intentionally trying to be almost as late as possible. It seems, yeah, it feels like a lot of it is it's sort of just being burned from the last war, which is, you can see in the way that Waller's the only one that wants to even tiptoe around the idea of calling it transitory. The rest of them.
Why do you think that is?
Yeah.
I mean, between Powell and Waller, one of these guys is the chairman. The other one maybe wants to be the chairman.
Yes.
But I mean, I think still, that's being maybe a little bit too cute. I think the argument has merit either way, regardless of maybe his incentives.
Yeah. So where does that leave us? Obviously, yeah, we're recording the day before the FOMC meeting tomorrow. There's no expectations of a cut for May. June is down to something like 30% right now. So what's your expectation and separate it between what you think they will do versus what they should do? It sounds like what you think they should do start to be easing basically right now.
Yeah, I think what they should be doing is probably being much more open to easing than they are. I think that I don't know that they should be cutting in May, but I think that they should probably be teeing up a cut in June. Now, because they're so unsure about everything, they're, very they're unwilling to give that guidance, I think. It's uncertainty. But I think what they will end up doing is, I think they'll start in July, and I think they'll be going 4 times this year. That's kind of where I'm at. I think the risk is that one of the moves is, could be the first cut kind of is the deepest. It could be a situation like we got last year where, maybe they've tolerated a little bit too much labor market weakness, and maybe they're doing a 50 basis point move at some point later this year. It's difficult to know right now, but nothing I see in the economy really suggests that the economy's like, what's the upside case right now? It's just like we get a bunch of trade deals and everyone's happy. Like, I don't know. Like, I think that's sort of ridiculous. I think, you just like, it's first principles, right? Like, the housing market is clearly slowing down. Like, we see evidence of that every single week. Companies are curbing their capital spending budgets. They're pulling their earnings guidance. They're giving out different scenarios for their earnings guidance. It's just sort of, if they're doing all of this, it probably means they're not investing. If they're not investing, they're probably not hiring. And consumers are seeing slowing income growth. That's not debatable. They're seeing a lot of the increase in consumption last year was driven by a drop in the savings rate. It's hard to see why that sustains itself. So you just go down the list. Consumer, softer. Investment, softer. Government spending, softer. And that was all before anything happened around trade. So ultimately, employment comes from growth. And if growth is slowing, you'd expect to see employment kind of sluggish as well. So that's sort of where I'm at. I don't, to me, it's a pretty clear case.
It's funny, if we recorded this just a few weeks ago, I feel like a lot of this Fed discussion, we would be talking about what would happen if Trump fired Powell, and what would be happening if Kevin Warsh took over and that sort of thing. And it feels like a lot of the heat of that has come down, obviously, because Trump has come out and explicitly said, I'm not going to fire Powell. But I am curious about, regardless, how do you think the Fed discounts that tail of fear, even if it just means undermining them? Does that further set them up to intentionally try to stay resolute and not cut, just to try to protect the independence and the sanctity of the Fed? Yeah, how do you think about all of that, even though the heat has come down on that idea quite a bit?
I mean, I think the best way for the Fed to maintain its independence is just to do a good job, right? So if it looks like they're being, I don't know, like intransigent, even in the face of like good data, like, I mean, or data that would, in normal circumstances push them towards cutting. I mean, I think that will invite attention. And, the last thing the Fed wants to do is invite attention on itself. I mean, I don't think Trump's comments about firing Jerome Powell are helpful. And I think he kind of figured that out, the costly way because of what happened with the fixed income markets. But, by his own admission, the fixed income market's beautiful again. And so, part of that is a function of people no longer taking seriously the threat of Powell going away. Because ultimately, like, the bond market is the arbiter. Like that, the bond market, in a way, is the protector of the Fed's independence, in my opinion. I mean, if the Fed's independence was seriously at risk, then longer run inflation expectations would explode. And, that would very much undermine any legislative agenda that the president's thinking about at the moment. So to me, that's where the protection of the Fed comes from. Now, that being said, we don't have many more meetings with Powell around anyway. And, Trump kind of understands this, where he's like, look, what's the point of firing him? I get to name my guy in a few months anyway. And, there have been people that have been thrown around, and I've been very vocal about who I think would be good. And, look, I think the economy evolves in very unexpected ways, and that affects politicians' political standing in different ways, right? And it kind of feels a little bit like that right now, right? I mean, the economy 6 months from now, I mean, maybe the unemployment rate's somewhat higher. Maybe stock prices potentially are somewhat lower. Maybe, we're not in a great place with the economy, and people are not willing to give Trump the rope that they are giving him now, meaning through their elected representatives. So what makes anybody think that he'll be able to get like his person over the finish line at the Fed? I don't know that that's necessarily the case. And because he's been behaving this way with the Fed, it's going to invite that much more scrutiny on whoever he puts up.
Yeah, right? It still needs to get confirmed in the Senate.
Well, he has still got, not only that, but if you put in a guy like Warsh, who's been known to be like almost consistently always hawkish on policy decisions. I mean, when he's wrong, he's usually wrong in a hawkish direction, right? So, and you have a president that's come out and said, yeah, I think they should be cutting.
It doesn't add up.
It doesn't add up. And, I mean, senators aren't that stupid. I mean, so they must be thinking, well, if he's willing to be dovish, or if he's willing to nominate someone who's always been hawkish, what does that say about this person? And we all know that Warsh has been desperate for this job for like God knows how long. And so I wonder whether that undercuts his chances somewhat. And maybe ultimately incentivizes Trump or pushes Trump to pick, a more consensus pick, let's say.
Yeah. Somebody like Bowman or Waller or something like that.
I mean, I think Waller would be a good pick. I mean, he's, look, I mean, that's a guy that's been kind of on the leading edge of a lot of the, I mean, he's, certainly during COVID, he was kind of like out in front of the committee. I mean, he kind of set where the ball was, and the committee ultimately moved to where he was. So I think, he's got like good forward thinking skills, and I think relative to the potential candidates, he would be a fine choice.
Yeah, he's got a good deadlift for him too.
That certainly helps.
Okay, just to tie a bow on the rest of this conversation here, is my last question for you is, based on everything we introduced of imminent recession, we don't know the depth or the length of it quite yet, but the rest of what we just talked about in the second half of this conversation, how do you think about the market correlations in terms of, especially around like long bond yields? Because if you're talking about an imminent recession, you'd imagine the long bond gets bid pretty aggressively here. But when you have all these other dynamics in terms of what you call like the bond market, arbiters or vigilantes, do you think we could see a situation where we get the recession, but you don't get the long bond bid?
I don't think like the laws of nature have been repealed just yet. I mean, to me, it's if people are risk averse, they're going to want to raise cash, and the U.S. Treasury market is still a pretty risk-free asset. So I that's kind of, I mean, I don't really buy in the whole, I mean, the whole sell America thing. I mean, if you define like sell America as days where the dollar fell, stocks fell, and bond yields rose. I mean, I think since Liberation Day, that maybe happened like 3 times, 3 trading days where you had that happen, like that combination of factors. So it's a very like dramatically oversubscribed story, I think. Um, America still has very, very deep capital markets. We're still a very large economy. We still do lots of trade with lots of people, and I mean, it's an open question about how much. I just don't really see it just yet. I mean, I think the fact that we still have a very, very deep capital market. I mean, there should be some. There is a reason why the dollar has gone down, and I think that makes sense. I mean, if you're kind of re-rating U.S. growth down, and you're kind of trying to trade less with the world, I mean, that's going to have negative ramifications for equities and the dollar, and you've seen that. But does that undercut America's safe haven status or the government's ability to finance itself? I'm somewhat more skeptical of that. And so, I think if you do get a recession, you'll start to see people scoop up bonds. So I think there's still good value in the long side of the yield curve here.
Mm-hmm. Yeah, fair enough. Neil, really great to get you on the show finally. Really enjoyed that. Where can folks go if they want to see more of your work?
Well, you can always catch us on Twitter or X at Renmac LLC, and you can always find me on my LinkedIn, Neil Dutta.
Amazing.
Yep.
Awesome. Thanks, Neil. Appreciate it.
Thanks, Felix. Appreciate that.